You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And today, before we begin, just a reminder, there is an opportunity for those of you who are interested to look at some of the distressed real estate and assets, things like that are coming through that are only available to accredited investors. You can get onboarded with our accredited investor club simply by going to wealthformula.com and clicking on investor club. And at that point, you get onboarded, and then you can basically see what's out there and see if it's of interest to you. Make sure you do that. There's still looks like there's buying opportunities, especially coming through, that continue to come through this year as well. So far, stuff coming up all the time. And so be ready, get onboarded. Anyway, with today's show, let's talk a little bit about the fundamental difference in the way that what we think of as traditional investors think versus those of us who maybe have erred towards the side of alternative assets. The traditional investor sees the stock market, bonds, and mutual funds as really the safe and stable way to grow wealth over time. And look, stability is not a bad thing. And there may be some truth to that overall, that there is, less volatility in the grand scheme of things. But here's the problem. How many people do you know who've actually become truly wealthy by just sticking with traditional investments? The answer is pretty much no one, right? You just, you can't do stocks, bonds, and mutual funds and fundamentally change your socioeconomic situation. Sure, you can retire potentially comfortably by essentially keeping up with inflation, making a few percentage points. But what you're really doing is just saving for the end of when you work. And it's not really there for the purpose of potentially creating this income or this, next level wealth that we all kind of frequently aspire to. Now, what about alternative assets? Well, we play a different game altogether. We know that big wins in the traditional market are rare. In alternative investments, we aren't just chasing stability, though. We are chasing those big wins. We're chasing some level of asymmetry. And I will say, yes, we absolutely still face risk, and the opportunities are not always going to be wins. That's an important reality that some people have realized over the last couple of years, because we went somewhere in the neighborhood of, 15 years in a row with nothing but wins. We still face risks, and there is times where we may lose, but the reality is the potential upside of alternative investing can be way disproportionate to what you put in. And that's just the reality. I'm not making that up. You just look at people around you. These are the kinds of opportunities that can accelerate wealth creation far beyond what traditional investments can offer. And that's why they're so attractive to those of us who are interested in it. Think about it this way. The traditional investor spends their career trying to essentially fill up a big cup of water, a portfolio large enough to sip from in retirement. Their hope is that they won't run out of water before they die. And that's the game plan. Save enough, live conservatively, and pray the cup doesn't run dry. But us alternative investors, we're a little crazy, especially cash flow investors. The goal is fundamentally different. We're not looking to hoard, a finite supply of water. We're building streams of cash that keep running no matter what. Streams that don't dry up, streams that allow us to live our lives without constantly worrying about running out. It's a completely different mindset, and it's not about rationing. It's about abundance. The difference in this type of thinking becomes pretty clear in this week's episode of Wealth Formula Podcast. It's an interesting interview because the guy I interview, he initially says that he's talking about something in a non-traditional way, but as it turns out, he's very much, I think, what we would consider a traditional investment advisor type. But do me a favor, listen to the show until the very end. And I will say that, I was a little baffled by the interview because I guess I just don't think the same way as guys like him. And not to say he's wrong, by the way, not at all. I totally respect what he does. It's just, you can tell that it's a confusing thing for me to listen to. In fact, afterwards, I asked Rod Zabriskie of Wealth Formula Banking to actually help me understand the confusion. So I sent him the video and asked him to do a little follow-up with me. Anyway, so listen to it until the very end. And we'll have the initial interview right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is David McKnight. He's an author, speaker, and investor, and president of David McKnight and Company. He's the author of The Guru Gap: How America's Financial Gurus Are Leading You Astray and How to Get Back on Track. He's also the author of Tax-Free Income for Life and The Power of Zero: How to Get to 0% Tax Bracket and Transform Your Retirement. David, welcome to the program. Well, you are the author of something called The Guru Gap, and how America's financial gurus are leading people astray and such. So, part of that assumption is that there's a lot of retirement strategies right now that are outdated. Can you talk a little bit about that?
Well, there are retirement strategies that I think are outdated, but I also think that there's some that are just plain out wrong. And in this particular book, I sort of trained my sights on Dave Ramsey initially. It's not a book exclusively about Dave Ramsey, but Dave Ramsey is the star of the show. And there's just a couple of things. I mean, the overall premise of the book is Dave Ramsey is good for bad investors, but he's bad for good investors. So if you're making 50 and spending 60, Dave Ramsey is precisely the person you should be talking to right about now. I mean, he's very good at inspiring people to get off of square one and on the road to financial freedom. But once you get to the point where you got $1 million, you start implementing Ramsey's retirement advice. It's the math really doesn't add up. And it's not just me saying it, it's PhDs all across the country who've done extensive analyses on what Dave Ramsey is recommending. And they say, not only is the math wrong, but his recommendations are dangerous. And if you follow his recommendations, you could risk running out of money, 15 years in advance of life expectancy, versus, implementing more conventional type retirement strategies. So one of the things that Dave Ramsey often talks about, I lead off the book talking about this, is he's really big on talking about an 8% sustainable withdrawal rate. In other words, if you have $1 million saved in your 401k by day one of retirement, you can take out $80,000 per year, year over year, adjusted for inflation every year until you die. The only problem with that, and I know it sounds great, and it's double what conventional wisdom tells us. We've all heard the 4% rule. But if you implement Dave Ramsey's advice in that instance, according to the guy who wrote the foreword for my book, Dr. Wayne Pfau, is one of the foremost experts on retirement planning today. He says 63% of the time you run out of money in advance of life expectancy. Not even a coin flip. It's 2 out of 3 times. And so these are the types of strategy. And I could get into what Dave Ramsey says about Roth convergence, which is sort of wildly at odds with conventional wisdom as well. But these are the types of things that I really take aim at in my book.
Got it. So what are your, so you are an advocate for, I guess, what you're calling conventional wisdom. So tell us what conventional wisdom would be here.
Well, conventional wisdom, if you subscribe to the 4% rule, says that if you have $1 million saved by day one of retirement, the most you can hope to withdraw, and have a realistically high likelihood that your money lasts through life expectancy is about 4% per year. So if you get $1 million, you can take out $40,000 the first year, $40,000 adjusted for inflation the second year, so on and so forth. And that gives you about an 85% likelihood that your money lasts about a 30-year retirement. That's one of the things that I address, but I also talk about the 4%, this 4% rule approach as being an expensive way to purge longevity risk from your portfolio. Longevity risk is simply the risk that you're going to run out of money before you run out of life. And that's, as it turns out, retirees' number one fear, running out of money before you run out of life. So the question becomes, if that's really everybody's goal, making sure their money lasts and stretches through life expectancy, what is the most cost-effective way of doing so? And one of the ways that you do that is by way of a guaranteed lifetime income annuity. And PhDs have been talking about this for 4 decades. The gurus I discuss in the book don't really like this approach because, for example, if you're Dave Ramsey and you think you can get 12% linear rates of return in the stock market portfolio year over year over year, why would you ever want to put money into an annuity? I mean, and if he were right, if you really could get 12% year over year returns in the stock market, why would you put money into an annuity? But annuity, as it turns out, is the most cost-effective way of making sure your money lasts through life expectancy. And so that's one of the strategies There are a lot of other psychological and health benefits that go along with it, but that's one of the strategies that is almost universally derided by the gurus I discuss in this book, but that PhDs for the last 4 decades have been sort of singing the praises of. And so why is there that tension between conventional wisdom and what these gurus are saying? That's one of the things I tackle in the book.
Got it. So tell us a little bit about annuities. Why should people be thinking about annuities? What are they? And, why is this something that you think is something that people should be adding to their portfolios?
Well, for annuities, a lot of people, annuities is a 4-letter word, but if you don't like annuities, you're not going to like that company pension you're planning on receiving. And you're certainly not going to like Social Security, because they all operate by the exact same principles. And basically what you do is you hand a chunk of your retirement savings over to an insurance company. And then in exchange, they give you a promise that you will receive a given level of income. You can adjust it for inflation. There's all sorts of different ways to slice it up, but you can get a given level of income every year till you die. And so this is a way of purging longevity risk from your retirement picture with 100%, confidence, right? One of the reasons why people like purging longevity risk from their portfolio by way of an annuity versus by way of the stock market approach is it's much less expensive. So for example, in the example I gave in the book, if I want $40,000 of income adjusted for inflation every year starting at age 65, and I want that to last through life expectancy, I need to save $1 million by day one of retirement. If instead I take that $1 million and I take 650,000 of that $1 million and I hand that over to an insurance company, they will give me that exact same level of income, $40,000 per year adjusted for inflation every year until I die, which leaves me $350,000 that I can do some really interesting things with. I can put that in the stock market. I can invest it heavily in stocks because I now have a permission slip to take a little bit more risk in the stock market because I've guaranteed my lifetime expenses. I've got a discretionary fund that will help patch the hole in the roof, or I could take that trip around the world or take the kids to Disney World, what have you. So the point is, it's much less expensive to use an annuity to purge longevity risk from your portfolio than really any other.
What kind of APRs or what kind of returns or dividends do these annuities usually yield?
Well, you're not, in its purest form, you're not looking so much at an annuity as having a rate of return. You're looking at it as you're handing stock market investments over to the insurance company in exchange for a stream of income. And so the stream of income is what we're looking for. And so you don't really compare.
Well, there has to be some idea for people, just in terms of who are used to thinking about IRRs or whatever, like on a yearly cash on cash basis or something like that to assess these things, right? Like, so if you put in $1 million into an annuity, what is the typical payout? I guess it starts after age 65 and goes in perpetuity, but what is that typically for, say, $1 million?
Yeah, so it depends on interest rates and what the prevailing interest rates are at the time. But like I said, if with under the 4% rule, you have $1 million, and that gives you $40,000 per year. If you can get for that same income, $40,000 per year adjusted for inflation, it only costs you $640,000. I mean, you do the math on that, but it's going to be higher than 4%. I don't know what that turns out to be, maybe 6.5%, something like that. So, that's a 6.5% withdrawal rate, which if you try to take a 6.5% withdrawal rate on your stock portfolio, you dramatically increase the likelihood that you're going to run out of money in advance of life expectancy. So, if you're talking strictly in terms of, if I don't annuitize the annuity and it's just, it's growing, over time, a lot of people look at annuities as a bond replacement. I frequently say, if you were to reach into your portfolio, remove the bonds, replace it with an annuity, you're going to increase your return, lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. And this has been backed up by reams of academic data that bonds are far more volatile than annuities. Annuities, you can't lose money, but you're also getting a productive rate of return. And so we're not necessarily saying that you should replace in that instance. you should replace stock market investing with an annuity, but certainly it's a very compelling thought.
No, I get it. I'm just trying. I think a lot of people just don't know what annuities are, so that's why I'm asking you questions about these things. So, I guess when you invest in an annuity, I put $1 million in an annuity. Does my income start the next year, or the same year, or does it wait until I'm a certain age? And will that determine how much I get paid back? Because obviously they're going to be sitting there for years and years if making money on my money if I'm not getting return right away.
Yeah, there's all sorts of different ways to do it. You can do what's called a single premium median annuity, where you in $1 million or whatever the amount happens to be, and then at the end of the next month, you start getting that stream of income. You can do what's called a deferred annuity, where you give them a pile of money, and then you defer that for 5 or 10 years or what have you, and then you start drawing in income at that point in the future. You can start on where it's a very open-ended proposition, where you give them money at the outset, and then you let it grow and compound, at 4 to 6% in the interim, and then at a point of your choosing somewhere down the road, you can start taking that guaranteed lifetime income. So it's very, very flexible. There are lots of different types of annuities out there.
Is there any tax benefits to this kind of income?
No, a lot of people are simply taking a portion of their IRA and rolling that into an annuity and drawing. So it would have the same sort of tax benefits in an IRA. I'm a real big fan of getting an annuity that has what I call a piecemeal internal Roth conversion feature, which allows you to convert money from your IRA to a Roth IRA inside that annuity, an amount of your choosing over a time frame that your financial plan calls for. Not all annuities have this, but it can be pretty interesting if by the time you start drawing income from these annuities, you've converted the entire thing to a Roth IRA, and then you're drawing that guaranteed lifetime income that's completely tax-free over the course of your retirement. And no matter how long you live, that money all comes to you in a completely tax-free way, which shields you from tax rate risk and can increase the likelihood that your Social Security is not going to be taxed. So a lot of benefits associated with that type of way.
What would the value of? So I'm very familiar with permanent life insurance, overfunded type policies, and to me, there's a lot of similarities here in that if you want to essentially create these overfunded policies, you can over time live on them, just by making tax-free, loans basically to yourself that are paid by the policy. So why would an annuity be any better than doing something like that?
Well, an annuity, they're apples and oranges. Annuities, like I said, in their most basic form, have a job to do. And the job is to guarantee that you don't run out of money before you run out of life. That's the number one goal of the annuity. There's lots of other sort of ancillary things that it does. Cash value life insurance doesn't really do that. I think the best application for cash value life insurance is what we call this, the volatility buffer approach. And this was borne out in a recent study by Ernst & Young. And basically what they say is if you can build up 3 to 5 years worth of living expenses in your cash value life insurance policy by day one of retirement, and then in the year following a down year in your stock market portfolio, you pay for your living expenses out of your cash value life insurance. What that does is it gives your stock market portfolio a chance to recover before you take further distributions. And that act alone can increase your sustainable withdrawal rate on your portfolio from 4 to 8% with a 95% success rate. And so this was the application that the Ernst & Young study used for cash value life insurance. And that's why their conclusion ultimately was the approach, the retirement approach that gives you the highest levels of income, the highest likelihood you won't run out of money, and passes the highest amount of money on to the next generation is 30% of your money going towards cash value life insurance, 30% going towards an annuity, and 40% going towards your stock market.
The Ernst & Young study used cash value life insurance in what way, though? Because they can really be, structured in very different ways. If you are overfunding it, it becomes a completely different animal than if you're just, if you're funding it the way that the traditional conventional guys tell you to do, so that the agents make money and yeah. So I'm very skeptical of studies like that, frankly, because I think you're looking at things that pretty unsophisticated investors would do. And I think with my audience, they're pretty sophisticated folks who are already doing a lot of these types of things. And I guess my question is, if we're doing overfunding of these policies, I mean, we're getting a lot of the same benefits. And there really is, from my perspective, not a significant risk of running out of money if you are overfunding these things maximally over a period of years and living off of debt, and that being tax free. Anyway, we don't need to keep talking about that issue, but let's move. Let's talk a little bit more about sort of your tax, your tax strategies. You talk about how taxes are vital to successful retirement plans, and of course, absolutely, this is this audience generally is a very much not into conventional markets in general, so they do tend to be in alternatives, and so we rely heavily on depreciation, cash flowing assets, things like that. So, tell us your approach to tax mitigation. Maybe drill down a little bit on what you talked about a little bit before on some of these strategies.
Mm-hmm. I think at the outset we have to lay a little foundation, and that's to say that I believe, and I've done a lot of research over the last 15 years on this, on the national debt and the trajectory of the national debt and unfunded obligations. We know that according to Dr. Larry Kolikoff out of Boston University, is about $239 trillion of unfunded obligations for Social Security, Medicare, Medicaid, and then interest on the national debt. What does that mean? That means that we would have to have $239 trillion sitting in a bank account today earning treasury rates to be able to deliver on everything that we promised that we can't afford to pay. So that's sort of a premise that we have to acknowledge at the outset, that we're on a very, very sort of apocalyptic trajectory as a nation, and that a lot of experts are now predicting that tax rates have to double to keep our country solvent. Recent Penn Wharton study said that if we don't either dramatically raise taxes or dramatically cut entitlements by 2040, that no combination of raising taxes or reducing spending will arrest the financial collapse of our nation. So that's sort of a context in which I give a lot of my recommendations. And so I'm very, very big on taking advantage of every nook and cranny in the IRS tax code. And that means utilizing Roth 401ks as much as we can, Roth IRAs as much as we can, strategically converting tax deferred assets to tax free, before tax rates go up for good. And then also utilizing, I don't think you should convert everything from tax deferred to tax free. You should leave, if you're a married couple, around $350,000 in your IRA. Why? Because that's going to produce an amount, it's going to produce an RMD in retirement that is equal to or less than your standard deduction, in which case that RMD is also going to be tax-free. So it's all about, I think, engineering your portfolio in such a way that you can have 5 or 6 different streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket. So
can you give us some, so just for perspective, this audience generally tends to be a high earning audience. Lots of physicians, lots of lawyers and business people, accredited investors, as we like to say. So can you give us some sort of a granular example, maybe walk through something that maybe somebody can get their head around?
So, I mean, this is obviously going to depend on what your modified adjusted gross income is, but between you and your spouse, you could put $8,000 each into a Roth IRA. You hit above $240,000 in modified adjusted gross income, that starts to phase out. But regardless of your income level,
by the way, that's going to be 99% of my audience is phased out, just for perspective.
So then between you and your spouse, you could put $30,500 into your Roth 401ks. So that's a pretty healthy chunk of money. And then I would say that if you don't have a lot of money in your tax deferred account, make sure that the match on that 401k goes into your tax deferred account. You want to have that $350,000 sitting in tax deferred by the time you retire, so that you can actually offset your RMD with your standard deduction. And then above and beyond that, you can either put money into your brokerage account, like Dave Ramsey says, or I think you could put money into cash value life insurance, where I think you're going to get safe and productive growth. I think it's, it's tax-free versus the taxable growth that you experience in a brokerage account. And I think that depending on what tax bracket you're in, the higher your tax bracket, the more it makes sense to do cash value life insurance. Because the net, when you compare the after-tax growth of the brokerage account to the tax-free growth in the cash value life insurance, the higher the tax bracket, the more likely the cash value life insurance is going to win out.
Got it. You talk a little bit about build a wealth strategy that gets you to zero tax bucket. I'm assuming that's all, zero tax bucket post, once you're retired, right? I mean, once you're living off of that. So, any sort of suggestions on that we may not think of in terms of tax strategies for today, while we're still working and earning and that kind of thing, other than your typical IRAs and that kind of thing?
No, I think I'm not, my sweet spot is not the alternative investments or real estate or anything like that. But I will tell you that I think it's important to acknowledge when you should be putting money into Roths versus when you should be putting money into the traditional tax deferred. I'm generally a pretty big fan. If you're in the 24% tax bracket or lower, you go Roth. If you're in the 32% tax bracket or higher, then go tax deferred. Even if tax rates are higher down the road, I think that it's going to be tough to really forego a 32% tax deduction today, because you think you're going to be in an even higher tax bracket in retirement when you're living on less income or what have you. So I think that's one thing that I point out, that if a lot of your listeners are in 32% tax brackets, I would probably continue to put money hand over fist into your tax deferred account and then just hope that your tax bracket's going to be lower in retirement when you're presumably spending less money.
Yeah. Any other advice for high earning professionals? We're talking, north of $300,000 that we didn't cover.
Well, I mean, I think a lot of it just comes down to how close do you think you are to retirement, right?
Mm-hmm.
A lot, I think that tax rates are going to rise precipitously in about 10 years. I think that sort of as we approach that 2040 date, the window within which America and the government can act to sort of right our fiscal ship of state. I mean, it starts to grow narrow, and then the fix on the back end becomes more severe and more draconian. And so I think you got to sort of ask yourself, how close are you to retirement? If you think you're going to be, you're 5 years from retirement, I think Trump is going to extend the Trump tax cuts for another 8 years. I think you can almost take that to the bank. And so that means you've got about 9 years within which to take advantage of historically low tax rates. In my book, The Power is Yours, I talk about the tax sale of a lifetime. We're never going to see tax rates this low in our lifetime at the end of, say 2033 or 2034. So I think that if you are going to retire in the next 5 years within that window, I think that you should definitely take advantage of those tax rates before they go up for good, because I think that when they do go up, they're going to go up dramatically.
Sure. David, the book again, the latest book, I guess, is The Guru Gap: How America's Financial Gurus Are Leading You Astray and How to Get Back on Track. I assume available pretty much everywhere you can buy a book these days. Great. And to reach out to you directly, do you have a website?
Yeah, davidmcknight.com.
Fantastic. Thanks so much for your time.
Sure.
Welcome back to the show. And usually at this point, I'm just kind of wrapping things up and giving you some thoughts on the show itself. But in this situation, I still was left kind of with some questions here about of some of the stuff that David McKnight was talking about, because it's a little different from to what we talk about on this show. So I actually invited Rod Zabriskie, who you may know, is given us a great education on a lot of life insurance type products and that kind of thing. We call wealth formula banking and wealth accelerator, things like that. Rod, how you doing?
Hey, I'm doing great.
Good. Well, first of all, give me your overall take on what you heard.
Yeah. So, I mean, my first thing to say is I was smiling a little bit because, like you said, because we live in this world and we see kind of what's happening. It felt like the two of you were kind of talking past each other a little bit, and like you were trying to get your kind of foothold on how do I ask him the questions I really want.
Yeah.
But he wasn't really catching the gist of your questions. And here's my thought on that.
Yeah, we'll go into that. What was
Yeah.
I asking? What was he not
Well,
getting?
so because he exists in this world, we always talk about, Christian and I always talk about it as the kind of traditional path to retirement, right?
Yeah.
You accumulate a bunch of assets. Most of the people are doing it inside of 401ks and the stock market and whatnot. And then you live off of those assets for the rest of your life, right?
Right.
And what David McKnight is doing, he's living in that same paradigm. He's just saying, choose different assets, have a different asset mix to do that. So, but the model is the same, build up assets and then turn those into retirement income. So like when he talked about annuities, well, that's within that mold of, hey, I have assets. What's the best way to and safest way to take income so I don't run out? Right.
Yeah.
So he's bringing up some of these things in that context.
Okay. Well, I did try to talk to him quite a bit about annuities. It's something that I get and I don't get. I mean, and what I was really trying to unwrap was like, okay, the annuity idea sounds like a good one, but it actually doesn't sound necessarily better than doing it through insurance products because, the insurance products actually give you income and then ultimately pay your heirs a dump of money after you die as well. Can you compare and contrast those two things? Because I think that's what I was trying to really understand.
Well, I think that when I think about where you come from, where I come from, this whole kind of rich dad, poor dad model of I'm going to build up enough passive income to replace my working income, and that's how I'm going to retire. Well, that's a completely different mindset compared to this kind of accumulation model that he was talking about. So when you talk about, say, wealth formula banking, right? Someone who's investing in real estate and notes and bonds, and maybe they're a business owner and they flow that money through their life insurance policy and build up this massive cash value. Then when they are in, I'm going to use air quotes, retirement, right? Most of the people that you and I talk with don't think about retirement in that same way because they still invest, they still grow, they're still building wealth, but they're just living off of some of the cash flows that's coming from them, right?
Yeah.
And when they get to that stage, then taking tax-free income off of that life insurance policy is a great way to supplement your income in that retirement phase. So that's the wealth formula banking side. We also have the wealth accelerator side, which is really geared toward creating tax-free income in retirement using leverage to
feel
maximize
like
what you can take.
The major, like the head-to-head, right, is what I'm thinking about is wealth accelerator versus annuities because, I mean, with wealth formula banking, I mean, like one of the big things is that it's really a way to add leverage to, cash flowing investments and make them more profitable and that kind of thing. But, annuities in theory, it's not a terrible idea, right? I mean, you just know you're going to get a certain amount of money per year until the end until you die. And there's some level of security in that. I get it. But I think the big head-to-head for me was an annuity versus doing a wealth accelerator type thing, which to me provides a lot of the same stuff. And then probably a lot more upside. And then in terms of the amount of income. And then again, the whole estate part of this, right? Like you're not just paying a lump to an insurance company that they get to just keep when you die. You just, you get a big payout to your heirs.
Yeah.
So what am I missing?
No, I think you're right on. And there's even an additional element to that when you're kind of putting them head to head. Because not only are we able to produce more income at the outset through the wealth accelerator compared with what an annuity could do, but we're also doing it in a way where we increase the income as you age through your retirement, and so you can adjust for inflation. And I'm not saying annuities can't do that, but if I want an annuity to adjust for inflation, then my starting point is a lot lower. And just to give you an idea, an annuity, especially like that's going to adjust for inflation. If I'm 65 years old, I'm turning that annuity on, I might only get 4.5% of whatever the asset was to begin with.
And it's probably less if you turn it on even before that, right?
Yes, right. The earlier you turn it on, the less it is.
So like if you're in your, late 40s, early 50s, it's like, okay, you want to turn it on and get what, 3%, 3.5%?
Probably. Yep.
And when we're talking about a lot of this stuff, after that 15 years or 10 or 15 years, we're talking about huge amounts of income.
Right. So especially as a percentage of what your net equity is in the plan, it's in the 10 to 15% range, right?
Yeah.
So I don't say that there's no place for annuities. If somebody has, let's say that you're looking at that time, kind of this retirement time, and you say, well, I'd like to have a baseline of income that's guaranteed. I can't outlive it. And so again, let's say your income needs is 200 grand, and you say, well, I want to create 50 of that in a guaranteed place. I can't outlive it no matter what.
Yeah.
Okay. Maybe someone wants to do that, especially because as you know, a lot of the people who listen to your podcast have money in 401ks, like maybe with a previous employer or before they saw the light, so to speak, they were doing that. And so if using that part of what you have built up to put towards an annuity and kind of create that baseline. So there can be some ways to think about it, but certainly not trying to create all of your retirement income through annuities.
Yeah. I mean, I just, again, quite honestly, and as you know, I do this accelerator stuff myself. I just don't see a real benefit. I mean, if you're worried about market fluctuations and things like that, if you're doing this through a leveraged IUL, like and tracking the market, well, you could also do the accelerator with whole life and still make more money than the annuities paying out.
Right.
Right. I mean, what would you get with whole life typically, like on average?
Yeah. So when we long-term measure IRR, and we're typically using a combination of the two.
Yeah.
But like, let's say you had 50-50 whole life and IUL, or 75% IUL, 25% whole life. Then you're in 12, 13, 14% IRR range.
Yeah.
If you said, well, I don't want any IUL, I want only whole life, then you're going to go somewhere around a 9 or 10% IRR.
Well, so that's kind of, to me, apples to apples, because if you say I want an annuity because I want this safety and security of being backed by an insurance company, well, that's whole life, right? I mean, that's whole life right there.
And the only thing is when you add the leverage, and you're adding another element of risk to it. So whereas annuities are truly guaranteed. As long as that insurance company is in business, they are guaranteed you're going to get this payout. We can't say the same thing as far as guarantees, but to your point, the consistency, the predictability, the long-term success, and kind of, again, just predictable nature of what the whole life does.
And it's ultimately backed by these big companies.
Same types of companies, right?
So that's my point, is it's still backed by the same company. If they're going to pay, they're going to pay. Yeah. Right. Yeah. But at any rate, okay, well, that's actually really helpful. Anything else before we cut out here?
No, I think that hits on the kind of the stuff that again, I had a little bit of a chuckle seeing kind of both of you talking
like we
past
were speaking
each other.
Different languages.
Yeah, because your experience is just so different from his, and yet he expects, like, most Americans come at it from that accumulation standpoint. And so when he's doing these interviews, you could tell like he's used to being understood a little more clearly, and there was a little bit of
he's like this
this
guy's in finance, doesn't make any sense. Well, and to that point though, I don't think that there is an element where the idea it might be to someday take assets that you build up and flip a switch, but it's in a different way. Right. It's not like giving that over to one company and then have them pay you just like 4 or 5% for the rest of your life. The goal, those situations, I mean, there's preferred equity in real estate, which is extremely secure in general, where, you're not actually getting equity. You're first in line after the debt, that's pretty generally safe stuff where you can get good returns. You can get good returns in high institutional. Even bonds. Okay, even bonds like municipal bonds or something like that, you can do better than those kinds of numbers. I don't say that there's no value to that, because I do think that is a type of creating passive income, but I just don't necessarily see that as the way to generate it. It's extremely inefficient, is what I would say. Yeah. So anyway, all right, cool. Well, Rod, I think in a couple weeks, we're going to do another webinar, just sort of as a reminder on the Wealth Accelerator. So we'll see you then. And thanks for joining me.
Thanks, Buck.
That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.